What if the biggest risk to your financial future isn't a stock market crash at all? What if the real danger is something far more silent? Something that feels completely safe, right up until the moment it wipes out decades of hard work. Most people spend their entire lives watching the daily financial news. They panic when the market drops 10%, and they celebrate when their account balance goes up. But according to billionaire investor Ray Dalio, almost every investor is watching the wrong clock. You see, we are conditioned to look at short cycles, the 5-year boom, the 2-year slowdown, the next quarterly earnings report. But underneath those small waves lies a massive 75-year economic supercycle, a cycle so large and so powerful that it only happens once in a person's lifetime, because it happens so rarely. Almost no one recognizes it when it arrives. They treat a structural shift as if it were just another temporary market dip, and that single mistake is how millions of hardworking people silently lose their purchasing power. Ray Dalio spent over 50 years studying this exact pattern. He didn't just study modern markets. He analyzed 500 years of global economic history, and what he discovered was a recurring mathematical blueprint, a pattern that has played out across different empires, different currencies, and different centuries, with terrifying precision. By the time you finish listening to this, you will see the global economy through an entirely different lens. You will understand where your money actually goes during a transition, why traditional saving strategies break down, and how a small group of strategic investors quietly protects their wealth while everyone else struggles. Before we can understand where we are right now, we have to answer a fundamental question. What actually is money? To most people, money is just the paper in their wallet or the digital number on a banking screen. But at its core, money is simply a token for human time and energy. When you work, you trade your effort for tokens, with the implicit promise that you can exchange those tokens for real goods in the future. Here is where the hidden trap begins. Every economy operates on credit. When you take out a loan to buy a house, a business asset, or even a car, you aren't just borrowing money from a bank, you are borrowing spending power from your own future self. Think about what that actually means. Right now, you get to spend more than you earn. It feels great. The economy grows, businesses expand, and profits rise. But somewhere down the line, the math has to flip. Future, you must spend less than you earn, just to pay back the original debt. Multiply that single human decision by millions of people, and you get the fundamental heartbeat of the economic machine. When debt expands faster than productivity, a cycle is born. In the early stage, credit flows easily. Anyone with a dream and a reasonable credit score can access capital. Businesses hire, asset prices climb, and everyone feels wealthier than they actually are. This is the short-term debt cycle. It usually lasts between 5 and 8 years. Central banks control this cycle using a remarkably simple tool: interest rates. When the economy slows down, central banks lower interest rates. They make borrowing cheap. People start taking out loans again, spending increases, and the cycle restarts. When the economy overheats and inflation rises, they raise interest rates to cool things off. It seems like a controlled system, an elegant, predictable machine. But here is the massive catch. The one central bankers rarely like to discuss publicly. At the end of every short-term cycle, interest rates are almost never raised all the way back to where they started. Why? Because the economy has accumulated too much total debt to handle high rates without collapsing. So with every single short-term cycle, the total debt burden gets slightly heavier. The floor gets raised, but the foundation gets weaker. This accumulation of debt doesn't disappear. It builds up over decades, quietly compounding in the background, like a silent reservoir filling up behind a dam. And that brings us directly to the giant wave that almost every ordinary investor ignores: the long-term debt cycle. Imagine a staircase. Each short cycle is a single step, moving up and down, but the entire staircase itself is slowly rising, higher and higher, until it reaches a physical ceiling. That ceiling occurs when interest rates hit absolute zero, or close to it. When interest rates reach zero, the primary lever of central banking breaks. They can no longer lower rates to stimulate borrowing because money is already virtually free. Yet, the mountains of accumulated debt still remain. Debt service payments continue to eat away at real income, leaving less money for real investment, less money for hiring, and less money for actual productivity. When this moment arrives, the old playbook stops working. Ray Dalio points out that throughout history, when societies reach this exact structural bottleneck, central banks only have one remaining choice. They cannot allow massive default, because a chain reaction of bankruptcies would destroy the entire banking infrastructure. So, they turn to the second lever, printing money. They create new currency out of thin air and use it to buy government debt. In modern terms, we call this quantitative easing, but stripped of its academic jargon, it is simply the dilution of the existing money supply. This creates a fascinating and extremely dangerous psychological paradox. When new currency floods the system, it doesn't instantly make everything more expensive overnight. Instead, it flows directly into financial assets first. Stocks go up, real estate prices soar. Fine art and luxury goods break record sales figures. To the average investor, this looks like a massive bull market. They look at their portfolio and think, I am getting richer. But Ray Dalio urges us to look deeper. Ask yourself this critical question. Did the actual real-world value of those companies or properties increase by 50% in 2 years? Or did the value of the currency used to measure them drop? This is the wealth illusion. When currency loses its purchasing power, the nominal price of assets rises. You might feel wealthier because the numbers on your screen are higher, but the real-world goods those numbers can buy are shrinking. Your wealth hasn't grown. The ruler you are using to measure your wealth has simply gotten shorter. So, what happens when this long-term cycle reaches its ultimate limit? What happens when printing money no longer creates real economic growth, but only drives up the cost of living? Historically, this is where the cycle shifts from an expansion phase into a deleveraging phase. Ray Dalio's research reveals that there are 2 distinct ways a nation can deleverage. One is painful, sharp, and destructive, what he calls an ugly deleveraging. The other is controlled, calculated, and rare, a beautiful deleveraging. In an ugly deleveraging, defaults sweep through the market. Debt is written off, spending collapses, and deep economic depression sets in. People stop buying, businesses close, and unemployment spikes. In a beautiful deleveraging, central banks print just enough money to cover interest payments and offset the deflationary pressure of debt destruction, without triggering runaway hyperinflation. It is a delicate, razor-thin tightrope walk. If they print too little money, the economy plunges into deep depression. If they print too much money, the currency collapses, destroying the savings of the middle class overnight. Here is the unsettling reality. Almost every government in history, when forced to choose between painful short-term depression or long-term currency devaluation, has chosen devaluation every single time, because short-term pain loses elections. Printing money postpones the reckoning, pushing the bill onto future generations. Now, ask yourself where we stand on this historical timeline. Global debt levels are at historic highs relative to economic output. Interest rates were held near zero for over a decade, fueling one of the largest debt expansions in human memory. Central bank balance sheets ballooned to unprecedented heights. We are not at the beginning of this 75-year supercycle. We are far, far down the line. So, how does a smart investor navigate a late-stage economic cycle? How do you protect the time and energy you've worked so hard to store, when the rules of the financial game are actively changing? Ray Dalio's approach does not rely on market predictions. He readily admits that predicting precise market timing is a fool's game. Instead, he focuses entirely on structural balance. Most ordinary investors build portfolios that only perform well under one specific condition: steady economic growth with low inflation. They own a basic mix of local stocks and standard bonds and hope for the best. But late-stage cycles are defined by extreme volatility. Inflation can spike suddenly. Growth can stall. and traditional relationships between assets can break down entirely. To survive, Dalio developed what he calls the holy grail of investing. It isn't a secret stock pick. It isn't a meme token or a speculative trend. It is a mathematical insight. If you combine 8 to 12 cash flow generating assets that are truly uncorrelated, meaning they react differently to economic growth and inflation, you can reduce your overall risk by up to 80% without sacrificing your long-term returns. Think about what that means. You aren't trying to guess whether tomorrow brings inflation or deflation, growth or recession. You are building an asset structure designed to endure whatever the cycle throws at it. When growth is strong, growth assets carry the portfolio. When inflation rises, tangible commodities, inflation-linked assets, and pricing power businesses protect your purchasing power. When growth stalls, durable, cash-producing assets provide stability. The goal is not to chase maximum temporary gains during a bubble. The goal is long-term compounding across an entire structural shift. The investors who lose everything at the end of a long-term debt cycle are almost always the ones who mistook a credit-fueled boom for genuine economic productivity. They piled into speculative assets at the peak, assuming the past 10 years would predict the next 10 years. They ignored the underlying machine. Understanding the long-term cycle gives you something far more valuable than a short-term trading tip.